Kia ora, I'm Nadine Higgins and welcome to your personal finance podcast, The Prosperity Project. I am on a mission to empower you financially. And while I work in finance, I'm a columnist, a journalist, an investor, a financial advisor, and a mum of two. I do not claim to be the font of all knowledge. So each week, I'll be bringing in the experts from across the world of finance and beyond to find out all the things you and I need to know. And if you want to get your questions in front of those experts, please email them to me, nadine.higgins@nzherald.co.nz. Whether you are a sole trader, a business owner, or you're running some side hustles, ideally you want to avoid trouble with the IRD. But tax can be confusing, especially when you're trying to figure out what you can and can't claim as a deduction. So what is legit? What's not? And how do you make the most of what you can claim without crossing the line? Catriona Knapp is the director at accountancy firm Future Focused Accountants, and full disclosure, she is also my accountant, but that's how I know she's really good and can answer some questions for us. So thanks for being with us, Catriona.
Thanks for having me along.
I think I'd like to start, if we could, with a bit of a definition, because I think people hear the word tax deductible and it sounds like some underhanded freebie that some people get and others don't. So what is tax deductibility?
Well, I guess put quite simply, it's costs that can be offset against your taxable income. So if you incur a cost in producing any income that you earn, then you can claim that against that income. And you've got to be in business for that. So it's not like you're an employee and you drive to work and you pay for parking. You actually have to be in business. So either owning a company or self-employed, a lot of people call it freelancing, then you're in that position where you can actually claim those costs as a deduction. And some of those costs could be as simple as your mobile phone, your computer costs because you need a laptop to do your business. So it might be subscriptions because a lot of people have online subscriptions that they use these days. There's a range of different costs that you can claim. But I guess the simple way to think about it is if it's any cost that relates either all in part to me earning that income.
Okay, but I guess that's where it can get a little blurry because, like you say, the subscriptions, I might just love watching the Kardashians, but I'm in the media industry, so I could claim, my Netflix account or my Amazon account as a legitimate expense. So where do you think people go wrong when it comes to working out what is deductible and what isn't?
Well, I think there's obviously that propensity for a lot of people to want to claim as much as they possibly can. And I always start off with people to say, well, you've got to be careful of the picture that paints. Because if the IRD ever come along and have a look and they see that you're claiming everything and they think that you're taking the mickey, then they're going to look harder. So I think in these cases where there could be some private benefit to some of these costs, then you need to take a portion of those. So the example you use with Netflix, there might be some aspects of it that relate to your business and there might be some that really are private. And the IRD would know that you use Netflix some of the time for your private viewing and your private pleasure. So my advice to clients is always take a position, claim half of it or claim whatever portion that you can justify that relates to your taxable activity that you're doing or your work.
Full disclosure, I currently have no Netflix account, okay? So no private or public use is being claimed.
Travel's another one, that's quite open for people to use their discretion. It's like, well, I've got to go to Germany for a trade show. So I need to fly over there, I need to stay there, and you need to come back at some point. And then we're going to tack on a week because we're over there, we might as well have a holiday. So you can do that, but obviously that time that you're there in a personal capacity is private. So you've got to have an airfare over there and an airfare back if you're just going to the trade show. And obviously if you were just going to the trade show, you would have your accommodation costs and your food costs. So that is all completely fine to claim 100% of. But anything outside of that for the extra days, then you just have to be seen to treat that as a private cost.
So you're not whacking that on the work credit card because that's where you're stepping over the line.
Yeah, that's right.
What about the home office? So I've got a business premises, but some of the time I'm working all hours of the day and night to keep my business afloat. What becomes claimable there and what isn't?
The home office is another interesting one, and I usually preface that with people to say, think about what you would be paying for if you rented commercial space. So if you rent commercial space, obviously you pay rent for the space, you've got to pay for You're part of the insurance, you've got to pay for part of the rate. So there's a lot of other costs that are apportioned to you. If the building has repairs done, often that's passed on to the tenant. So that sort of cost can be claimed as part of your home office costs. So if you've got to repair parts of the home, if you've got to repaint it, your rates, your insurance, you can claim a portion of that. But you can't claim the pool guy. You can't claim the landscaping, all of those sorts of things, because you wouldn't claim that or you wouldn't be charged that in a commercial environment. So it's all about being relative and thinking, okay, this is because I don't have an office space elsewhere, so what would I be charged for in that circumstance? And the other thing where I find people go wrong is they say, oh, but I use all of my house for the home office. I have to use the bathroom, I have to use the kitchen because I have to make people cups of tea. And the IRD see it very much from an area principally used for business purposes. So obviously the kitchen is primarily personal, even if you use it to make the odd cup of coffee for people that might drop by. The same with the bathrooms, all of those sorts of things. So you've got to think it's the area that's principally used for business, and they come at it from a point of view of they expect a room to be set aside with a desk and a filing cabinet and everything else that you might need for your business.
So it doesn't count if you're working from bed?
Unfortunately not, unless that's all you've got in your flat because it's very small.
Okay, good to know. What about entertainment? Because when I started reading through the IRD guidelines on this, I very quickly got confused. It's perfectly legitimate that maybe to get business, you might have to entertain a client or buy a gift or whatever, but there's lots of different rules as to whether it's 100%, 0%, 50%. Can you give us some kind of simple guide?
Yeah, well, the simple guide from a 50% versus 100% point of view is if you're away on business, if you're out of town and you are having to buy food for yourself, then that's 100% claimable. But as soon as you start to entertain somebody, then that becomes 50%. So the 100% is where you cannot choose who enjoys that entertainment. So if you're at the home show with a stand and you put some food and drink there, then you can't stop anyone coming up and, well, you could, but it wouldn't go down very well, enjoying that food and that drink. Whereas if you select a client to take out to dinner, or you select a staff member to take out to dinner, or you put on the work Christmas party, then you are choosing who's going to enjoy that entertainment. So as soon as you're choosing, then it's 50%.
Okay, that is actually more straightforward than I expected. What I am wondering, though, is how much do deductible expenses change based on the kind of work you're in? And for example, if you're a dog walker, I presume you know the poo bags, the leads, the vehicle, the shoes you walk in, deductible expenses, surely. But if you're a real estate agent and your job is to look shiny and expensive, and like you sell great houses, are the heels and the Botox and the hair and the makeup deductible expenses?
Not generally. The IRD, when they talk about uniforms, they say it has to be branded. So if you're a real estate agent and you buy a really nice suit and you put your organisation name on it, then technically by the rules you can claim all of that. But if you don't, then they see it that if you've got a wedding or a nice engagement to go to or some function, then you could wear that outfit and those lovely heels to that same function, then you're not using it 100% for business. And even if you say, but I only do that for business, I only wear those things for business, they don't care because it's not branded.
Okay.
So again, it's one of these situations where if you've got something and you like to buy very nice suits or you like to buy very nice shoes, and principally you are only going to wear them for work, then that's why I talk to people and I say, well, these are the rules, but, you know, how about taking a portion of that? Because it's a much easier argument to have with them to say, well, look, we know that it's not branded, but clearly this is what we do use for our business. They would understand that. Well, any reasonable person would. And, you know, I think you're more likely to get away with that because you're in a position where you have actually made some apportionment and acknowledged the fact that there is a personal benefit there.
What about the grooming thing? Is there any case in which looking the part for your job would be a tax-deductible expense?
Well, I do see it a lot in film, TV, those sorts of industries, and people do claim a lot. And I'm not aware of any situation where people have been caught out by that or there's been an audit and that's been a problem. But in saying that, it all is about the size of what you claim too, you know, and again, it's a symbolism thing. If I'm advising people, I always say, well, look, you know, although you need to look good, put some of it as a personal expense. So acknowledge the fact that, yes, I need to look nice and I need to have a nice haircut and what have you, but there is an element of personal grooming associated with that, not just looking good from a business point of view. So, like I say, I've never been involved in that being tested, but for me, that's the position that I take.
What about cars? Because you might quite legitimately have a business vehicle, but then you drive it home and at the weekend you go to the beach and the supermarket or whatever. Where's the line as to what is deductible travel and what isn't?
Yeah, cars is an interesting one, and it's a very hot topic with the IRD. So I usually start off with people and say that is not an area to push the boundaries. So buying a Porsche and saying that you are just driving it for work purposes and you're claiming everything is probably not going to do you any favours if they come looking at you. So it is a matter of, and there are some quite firm rules around that. For example, a lot of people get caught out on the home to work travel, and that particularly affects contractors because they say, well, I'm a contractor, so effectively I'm based at home. And so every time I leave, I'm going to work when I take that vehicle. But that doesn't matter because the home to work travel is one that the IRDC is not claimable for tax purposes. So once you get to the base where you need to be, if you're driving around, then of course you can claim that. But a lot of people do get caught out with that home to work travel, particularly if they're keeping a logbook as well. And it's the old one, well, how about if I call in at the post box on the way? Well, they have actually recently written that is not an acceptable excuse. So it has to be the dominant purpose of going somewhere has to be business related.
So if I own a car in my company and I'm using it for some personal business and some business, do I have to necessarily keep a logbook of everywhere I go and what I'm doing, or is there another way to skin it?
You pay fringe benefit tax.
Right, so what's that?
And that's where you actually pay another tax.
Okay.
Yeah.
And so that's simply to acknowledge that, yes, you're using it for business, but actually we acknowledge you're using it for private as well. It's all above board. You just got to pay tax on the private bit.
Yeah. And that is it's a prescribed formula across the board. So if you have a vehicle in a company and it's available for private use, then you have to pay fringe benefit tax, or you have to do what we call a fringe benefit tax contribution adjustment if it's a shareholder employee, and that effectively creates the same situation from a tax point of view. But it's a better way for people to go in terms of if you've got a lot of private use, if you put it into the business and you do the fringe benefit tax either adjustment or you pay the tax, which is one and the same from a financial point of view, then it works out in your favour, because you can imagine you can claim a whole lot of your personal expenses now or personal vehicle costs become tax deductible.
Here's one that I cannot claim to have any solid handle on what it means and how it works, so I'm hoping you can help me. Depreciation. When your business buys something and then it depreciates that asset and then claims the depreciation as a deduction on your tax return. Can you make that make sense for me?
Well, the easiest way to think about it is that as soon as you buy something that is going to last longer than 12 months, that costs over $1,000, that is what's termed an asset. Because if most of us think about assets, we might think of big things like homes or cars, and of course they're going to last longer than 12 months. And if you buy a computer or a printer or something like that, that costs over $1,000. Most of us would like to think it's going to last longer than 12 months. So when you're in that position, it's considered an asset, and you should be able to claim that asset over time. And that's what effectively depreciation does. It allows you to claim a portion of that asset over what the IRD determined to be the asset's useful life. So if you think about a mobile phone, for instance, in most cases they don't last long. So typically they are depreciated over about a 2 to 3 year time period. Whereas if you were thinking about a desk, or if you're thinking about trades-based businesses where they have tools and things like that, they last a lot longer. So the depreciation rate for them is a lot lower because the expectation is that they might last for several years, 5 and beyond. So
is it that, so say I buy something for $2,000 because the threshold is $1,000, right? I then go over, 5 years, on paper it drops in value each year, and the amount it drops in value is the amount that I use to offset my tax.
That's your expense that year. So the amount of depreciation that you can claim is what the IRD consider to be the amount that asset has probably reduced in value for that particular year. So you can claim that as an expense against your income. And I say to clients too, in an ideal world, you would be taking that amount of money and you'd be putting it into a savings account, because then when you need to replace that asset, you've got the money sitting there so you can buy a new one. Invariably, that doesn't happen because life's expensive, but that's an idealistic approach. But also the way the depreciation system works is you can write an even amount off each year. So if something costs, $2,000 and it can be written off over 4 years, then that's $500 a year. But the IRD also allow you to have what they call a diminishing value approach, where you're writing off more in the initial years because they recognise the fact that usually you get a bigger drop in value when something is new.
And people might have heard in the most recent government budget investment boost, which was all about depreciation deductibility. How does that improve things or incentivise people to invest in their businesses?
Well, it gives you that 20% of the asset value as a straight deduction up front, and then you apply the depreciation rate to the remaining balance of that asset.
So you just get to depreciate more in the first year, so it helps relieve the tax burden more in year one?
Yes.
Okay.
So it is an idea that it will reduce your tax, so it gives you a little bit more money in the bank, so hopefully you can use that money to either invest in the business or invest in new assets or something like that.
Well, you've done a great job so far of making this simple, but I've got more to ask you. We do need to take a quick break, and after that we're going to see whether there are any things that the poor old employee can claim as a deduction. Back in a moment. Welcome back to the Prosperity Project. We're speaking to Catriona Knapp, who is a director at accountancy firm Future Focused Accountants, about tax deductibility, and she's done a great job so far of demystifying a lot of it. For me, at least. I hope you're finding it the same. I'm wondering, Catriona, what happens when your clients are going, yep, this is deductible, this is deductible, this is deductible, and then they come to you at the end of the year and you go, what are you thinking? This is not deductible. What happens?
Oh, you do have a few interesting discussions. I did have a client one year, I will never forget it, where he wanted to claim his Rolex watch so that he could get to meetings on time.
Oh my gosh.
So that was an interesting one. And needless to say, we did not claim the Rolex watch because I did talk to him about how he would manage to justify that to the IRD. But you do have some interesting discussions with people around what they think they can claim and what, really you should be claiming.
And so when you're fixing things up based on what the client thinks and what can actually go in their tax return, how does that work? Are you just going, okay, that's not a deductible expense. Actually, we have to class the Rolex as a drawing. What does a Rolex cost, like 30 grand or more?
It depends on the Rolex, doesn't it?
Does that mean they end up paying more tax than they thought they were going to?
In some ways, because if you imagine if you're trading through a company, then if you've got the Rolex in there as an expense and all of a sudden it's not there, then your company profit's going to be higher, which of course the bank like, and obviously the IRD like too, but you don't tend to like if you're writing out the cheque for the tax. And when it comes to drawings, that's where a lot of people get confused because they think, oh, well, if it's drawings, I pay tax on all of my drawings. You don't pay tax on your drawings. You pay tax on what your accountant allocates you as a salary. So in many respects, that might be equivalent to what you've drawn out of the business. In some respects, it might be a little bit more, particularly if you're a great saver and you don't draw much out. It might be more tax efficient to record more as personal income because you might have a cheaper tax rate. Or in some cases, if we go back to the old Penny and Hooper case for the doctors years ago, then a lot of cases...
Was this the surgeons and they were only paying themselves 70 grand or something to be under the top tax bracket or something like that?
That's right.
Yeah.
So in those cases, you're often having to declare more as a salary out to the shareholder because of what happened in that case and because of the way the IRD view personal services in particular. So that's another minefield in itself, which we could probably talk about in another time.
Yeah. So what are the consequences of getting it wrong, of being a bit too greedy on the deductions or just pushing the envelope a bit too far?
Well, obviously, if you get audited by the IRD, you could have penalties on underpaid tax. You could have interest. It does put you in the spotlight a little bit. It's just the overall impact of that. It's like anything. When you're in a situation where you're in trouble, particularly with a government department, then there's stress associated with that. And that takes your eye off the ball from a business point of view. So I think in a lot of cases, while there's upfront cost financially, there's a ripple-on effect in terms of the stress it might have on you, the time it takes you to defend these things. Also, if you're going to the bank for lending and you've got these big IRD adjustments that they can see in the accounts, that might start them thinking about, is this an organisation I want to deal with, or are these individuals I want to deal with? So there's a lot of things that can flow on from something which is just simply being a little bit too greedy.
Yeah, and can people spend so much time focusing on reducing their taxable income that they're actually not thinking about, I need to make this business profitable, not just reduce the amount of tax I pay?
That's right, and often I do talk to people about that. It's all well and good asking me what expenses that you should be incurring so that you pay less tax, and I explain to them that your tax saving is only a percentage of the overall cost. So if you're trading through a company and you've got a tax rate of 28% and you want to go down the road and buy some flash new whiz-bangy machine or something, you've still got to come up with the other 72% of that cost. So there's still a cash outflow. You need to be able to afford that cash outflow. And motor vehicles is a classic case where people think, if I go down the road and I buy a Porsche and I put it all through the company, then that's going to save me a whole lot of tax and I get to drive a really nice car. Well, part of that is true, but the other part is you're only getting a tax deduction to the tune of that 28%. And of course, with vehicles like we highlighted before, there are other tax consequences to take into consideration.
So at its essence, if the business doesn't need it and it doesn't help you earn more income, you're spending $1 to save 28 cents.
Exactly.
Right, which doesn't make a lot of sense, does it?
No, and like you said before, the focus is in the wrong place, because if you put that energy into selling more, then incrementally you're going to be better off.
Yeah. I want to talk about employees because, that's probably the majority of the population, and they're sitting there listening to this going, what about us? Are there any things that you can deduct from your tax burden as a PAYE employee?
Not a lot in this country. If you want to deduct a lot, then you need to go and live in some of the places in Europe, because I found that there's a lot more that you could claim over there than what you can claim here, which was quite interesting at the time. But one of the things you can claim here is your income protection insurance. So if you do pay income protection insurance, it's worthwhile asking your insurer for an annual tax statement, because what you can claim is not 12 times your monthly premium. It's often a portion of that, because there are only portions of that premium that are considered income protection, and often it rolls in other benefits as well. So you do have to be a bit careful there. You can claim donation rebate for any donations you make, and a lot of people do make donations and they forget to do that.
And you have to remember that often the school fees are a donation, right? And so that's actually a tax deductible expense.
Yes, it is. So for a lot of cases, if you're paying $300 or $400, you're getting a third of that back. It is actually worthwhile completing the return.
Absolutely.
And so I would think there'd probably a lot of people out there that don't do that.
Yeah.
The other thing to bear in mind is if you you take out a loan to buy shares, and the interest on that loan is also tax deductible. So a lot of people forget about that, or if they're taking out a loan to buy shares in, let's say, a company that they're going to work in, as soon as you take out a loan to buy shares in something that's going to generate assessable income, then you can claim the interest on that.
Okay, so there's not loads, and maybe we all need to move to Europe. Maybe just to wrap things up, what would be your key piece of advice to people who are, let's say they're starting from a clean slate, they're becoming self-employed, they want to maximise their deductions, but they don't want to get greedy and get themselves in trouble. What is the best approach to take?
What I usually say to people is, if in doubt, put it through. Because if you've got a good accountant, they will go through it, they will ask you questions, and if they think you shouldn't be claiming it, then they'll explain why, and you'll learn from that. I usually say to people, the worst thing you can do is assume that you can't claim, because if you're trading and doing what you should be doing and putting all of your business costs through a separate bank account, your accountant's never going to see it. So the question is never going to get asked, and you're never going to address it. So the best thing to do is think about that linkage. Any expense that you claim needs to have some relationship to the income that you're earning. And if you think it does, then my advice is put it through and expect to be challenged on it or asked a bit more questions, and then you'll learn from it as you go.
Yeah, and just get a good accountant like you.
Thank you for that.
Catriona.
Thank you.
I don't need to know all these things because I've got Catriona. Thank you so much for your time.
Oh, thanks for having me along.
Thanks for listening to The Prosperity Project. You can follow this podcast on iHeartRadio or wherever you get your podcasts, and please do chuck us a rating or a review while you're there. For more personal finance and business content, head to nzherald.co.nz, and please do feel free to get in touch with your questions and your stories. nadine.higgins@nzme.co.nz. A reminder though that this podcast is informational only and nothing we say here should be considered personalised financial advice. But also remember that while listening to this podcast is hopefully going to be additive to your financial knowledge, and that is fantastic, knowing stuff doesn't create change. Doing stuff does. So what action are you going to take today to make your life more prosperous? My producer for this episode is Ethan Sills. Sound engineer is Richard Martin. I'm Nadine Higgins. Thanks for listening to The Prosperity Project. Brought to you by moneyfit.me.